Okay, dear students, first of all, a little introduction about myself. I'm Abil Ahmed, CEO and Principal of Abil School of Accountancy. And as far as FM Financial Management is concerned, so the highest marks so far scored by my student, they're 94. The way back it took world position. So we have, alhamdulillah, we have the honor to produce world top in FM, AFM both. Highest marks in FR, so far we took that is 92. The way back in taxation, we took 99 marks. ATX, we have got number of positions. And recently we took a position in AFM in Zimbabwe. So then a long history of positions, alhamdulillah. Now let's come to the point what exactly we are going to cover in these live revision classes. Number one, every Monday, same timings, we'll be having the live revision class. What are we going to cover? That's very important. Number one, we'll be discussing and we'll be revising the topics through questions. Like today, we have selected the questions. They are from the past paper and BPB kit. In the next class, there will be questions. Either they will be from Kaplan kit and past paper, or we'll be taking the question from Study Hub and the past papers. So in every class, the material will be from a different source. Like today, if we are doing questions from BPB, then in the next class, definitely the question, there will be topics will be different, obviously, not the same which we are covering today. Different topics and questions, they will be either from Kaplan kit or from the Study Hub. So that within these live revision classes, you should be having the flavor of each and every area, like questions from BPB, Kaplan, and Study Hub. I will try to give you the revision of more or less each and every topic of FM, but through questions. So the agenda and the class is on every Monday. Okay. So let's start. So agenda, I hope it is clear to everyone. Let's start from a very first question. Are the following statements about bonds are true or false? Unsecured bonds are likely to require a higher yield to maturity than equivalent secured bond. Makes sense, very much true. Obviously, if I'm an unsecured bond holder, so obviously I need a higher return as compared to a secured bond holder. Because secured, they are secured. So I am unsecured, so I'll be asking a higher return. So first one is true. Convertible bonds give the borrower the right but not the obligation to turn the bond into predetermined number of ordinary shares. Objection is on this borrower. Actually, when you are the investor of convertible bond, when you are the buyer of convertible bond, then this option is with the investor of the convertible bond. This option of either conversion or not is with the buyer of the convertible bond. It is not with the borrower. So basically the problem is instead of borrower, I think they should have written investor. Then obviously it would have been correct. But right now it is false. Because convertible bond, they give the investor the right not to obligation to the investor, not to the borrower. So the second one is false. A euro bond is a bond that is denominated in a currency which is not a native to where the bond itself is issued. True. Actually, euro bond does not mean that you are going to issue the bond in euro. A euro bond is a bond that is denominated in a currency which is not native to where the bond itself is actually issued. So for example, if a Pakistani company is issuing bond in USA, so I'll say this a euro bond. True. According to the creditor hierarchy, list the following from high risk to low risk. Look, read the question nicely. Sometimes what happens, an easy question, becomes difficult or student they make mistake when they're not reading it nicely. They're saying according to the creditors hierarchy, list the following from high risk to low. Okay. The most, I would say, the one who faces the highest risk is ordinary share. Number one. Highest risk is actually faced by the ordinary shareholders. Why? Because in the event of liquidation, first of all, we make payment by selling all the assets. We make payment to the secure debt holders. Then we make payment to the other debt holders. Then we make payment to the preference shareholders. Then at the end, we make payment to the ordinary shareholders. And normally, when the time of ordinary shareholder comes, normally we don't have funds to pay them. So the highest risk who faces ordinary share capital. Number one. After that, preference. We are going from high to low. High to low. Then trade payable. Bank loan with the fixed and floating charge faces the lowest risk. So I hope it is clear to everyone. Now let's go ahead. Now what they are asking, that's very important. Calculate theoretical exercise price and right issue price. Before doing this question, a simple example. Actually, what is the meaning of theoretical exercise price? Theoretical exercise price means share price after the right issue. And whenever a company makes a right issue, there is an anticipation of stock exchange, not mine anticipation, it's an anticipation of stock exchange that everyone will be selling the right shares. When everyone will be selling the right shares, it will increase the selling pressure. When the selling pressure increases, then share price will drop. So theoretical exercise price means share price after the right issue. How do we actually calculate that theoretical exercise price? Let's see that first, then we'll come to the question. Simply, we make three columns: shares, values, and let's say total value. Assuming company makes a right issue, one right against two ordinary shares. One right against two ordinary shares, assuming share price before right is 12. Share price before right, I'm assuming it is 12. Right issue price, I'm assuming it is 9. Let me repeat. One right against two ordinary shares. And share price before right is 12. Right issue price is 9. If I simply multiply them, I'll get 24. Here I'll get 9, 3. So 24 plus 9 gives me 33. So I can say one thing. Now we can say one thing, that three shares are having total value 33. Three shares are having total value 33. Students, if three shares are having total value 33, we can easily calculate the value of one share. That is theoretical X right price. Theoretical X right price means share price after the right issue. 33 divided by 3, I'll get 11. 33 divided by 3 gives me theoretical X right price. Okay. Now, when I'll be getting one right for $9, then I'll be able to sell the right for $11. Because after the right issue, price will not be $12. After the right issue, price will be 11. So I have a question, students, please answer. If in this company, I'm getting a right issue for $9, I'll be able to sell that right for 11. Then on one right, how much I can earn? You can say gain per right issue. I'll be selling it for 11, buying it for 9. So there's a gain of 2. Okay. Now, in order to have the gain of $2, another name for this is value for right per new share. So in order to get the gain per right, $2, can I say shareholders should be having at least how many shares? 2 shares. Because what company says, we are issuing one right against 2 shares. Now, if I want to spread this benefit on existing shares, so we'll say value of a right per existing share. Simply the gain divided by existing shares. Right now, it's just a coincidence we have existing shares also too. It means per existing share, the benefit of the right per existing share is 2. The benefit of the right per existing share is 1, because per new right, the benefit is 2. Per existing share, the benefit is 1. Now, look at the entire calculation. Total 3 shares, they are having total value 33. So one share is having a value of 11. That is theoretical X right price. Then gain per right, which is 2. Value for right per existing share is 1. Now, sometime what your examiner does, he gives you the question on the same topic, but wants you to do a little bit of reverse working. Now, let us just play with the data which is in front of us right now. If I give you a value of a right per existing share, okay? And I want you to give me the gain per right. If I'm giving you a value of a right per existing share, and I'm asking you, give me the value of a gain per right, or just give me a value of a right per new share. This is another name is value of a right per new share. So very easily you can calculate, because per existing share it is 1. The ratio says in order to get one right, you need to have how many shares? 2 shares. So how will you calculate value of a right per new share? You will take value of a right per existing share, multiply by the ratio. It is 2. Now I've got a value for right per new share, which is 2. Fine. Now come here. Look at this. Right issue price is 9. Right issue price is 9. Theoretical X right price is 11. Okay. If my examiner gives me a right issue price which is 9, and enough data is not given to me, but now examiner is asking, give us the theoretical X right price, but I have somehow calculated the value for right per new share. So how I'm going to calculate theoretical X right price? I'll take the right issue price plus I will add the value for right per new share. That will give me the theoretical X right price. Now, there's another way to calculate the theoretical X right price. Share price before the right issue. Share price before the right issue is 12. Value for right per existing share is 1. Now look at this. Theoretical X right price is equal to share price before right issue minus value of a right per existing share. So theoretical X right price Share price before right issue is 12. Value for right per existing share is 1. So here comes theoretical X right price, which is 11. Okay. Now I have a theoretical X right price, let's say. I also have, let's say, value for right per new share. Now my examiner is asking me to calculate right issue price. I can calculate that also. Right issue price is equal to theoretical X right price minus value of a right per new share, or you can say value per right, you can say gain per right. So student, you should be really good in dealing with this data like this, because sometimes a very simple thing becomes little bit difficult in exam if you don't know how to do the reverse calculation. So I hope this reverse calculation is, because the entire data is in front of you. If we need to calculate right issue price, so what to do? If we need to calculate theoretical X right price, then simply share price before right, then value for right per existing share. Now let's come here, and I really want every one of you, and I'll give you around 2 to 3 minutes. I want everyone to attempt this. They're asking us to calculate theoretical X right price, and they're asking us to calculate right issue price. Students, I'm giving you 3 minutes. I want everyone to attempt this. And then within 3 minutes, we will be solving it together as well. But I really want everyone to attempt this. I hope you people have attempted. Samin company is planning a 1 for right issue. And let me tell you one more thing, which I did not tell you at the start of the class. A recording of first live revision class that will be uploaded on our YouTube channel as well. But after that, like the class which is going to be next week, and every Monday we'll be having this class. But upcoming classes recording will not be uploaded on YouTube. So try to avail this opportunity and try to come live and take the class. Obviously, those students that are enrolled, they will get the recording. But someone who is not enrolled will have the chance to see the recording of only first live revision class on our YouTube channel. Okay, now let's see. I hope it is clear to everyone now. Samin company is planning for 1 for right issue. The value of a right has been calculated 0.40 per existing share. Per existing share. Simon company market price is currently 7. Let's see the answers. It's currently 7 per share. What is the theoretical? Now look at this, student. Theoretical X right price. I'll take the current share price, which is 7. Come here, please. Current share price is 12. Look at this. Current share price minus value for right per existing share. Current share price minus value for right per existing shares. Value for right per existing share, they have given us 0.4. So can I say straightforward, I'll get the theoretical X right price 6.60. Again, come here. Look at the formula. Share price before the right minus value for right per existing share. I'm applying simply this one. I hope it is clear to everyone. What else examiner is asking us? Now they are asking us the right issue price. Right issue price. Now come here. Right issue price, right issue. Look at this. Theoretical X right price minus value for right per new share. Theoretical X right price minus value for right per new share. can I say theoretical X right price we have calculated 6.60 minus value of a right per new share now. The ratio is against 4 existing shares. We'll give one right. And per existing share, the benefit is 0.4. Now listen. Value of a right per new share. Simply 4 multiplied by 0.4, this will give me 1.6. So how will you calculate right issue price, theoretical X right price minus the gain per right minus the value for right per new share, which is 1.6. So logically, right issue price is $5. So student, you can see that if you don't know how to do a little bit reverse calculation, then a question which looks very simple could become very tough. So the answers are theoretical X right price and right issue price. I should be writing properly. It looks a little bit different. Right issue price. So 6.60 and 5. I hope it should be crystal clear to everyone. Because before doing this question numerically, I have given you an example. Okay. Now let's go ahead. Which of the following best describes the term coupon rate as it applies to bonds? Now listen. For example, if I'm saying my company has issued 10% bonds, normally the par value is $100. Now try to understand. Coupon rate means the rate which is written with the bonds. Coupon rate means the rate which is written with the bonds. If it is 10% bond, then coupon rate is 10%. If it is 12% bond, then coupon rate is 12%. If it is 15% bond, then coupon rate is 15%. And coupon rate is applicable on par value. Another name for the par value is nominal value. So coupon rate is applicable on par value. It is applicable on nominal value. Another name for the coupon rate, you can say, is a cash interest rate. And companies, they pay cash interest rate by applying the coupon rate on par value. Now come here. Which of the following best describes the term coupon rate as it applies to bonds? A return received taking into account capital repayment as well as what? Interest payments does not look like what we have just discussed. Annual interest received as a percentage of nominal value of the bond. Look at this. The second one, annual interest received as a percentage of nominal value of the bond. This is what coupon rate is. Okay, now, which of the following describes a sukuk? Actually, sukuk, you can say sukuk is an Islamic bond. Traditionally, all the features of traditional bonds are prohibited in Islam. They're not acceptable. Like traditionally, what happens? When company raises finance through issuance of bonds, then companies will have to pay interest, either they are earning or not. So obviously, interest is strictly forbidden in Islam. Number one, is prohibited in Islam. Number two, you are using the money of bond holders and they are having no share in your organization at all. So basically, all the characteristics of traditional bonds are not acceptable in Islam. So we issue sukuk. You can say sukuk is an Islamic bond. Now, in sukuk, actually, what happens? For just an example, okay, assuming there's an XYZ airline, and that airline, assuming issues sukuk to raise the finance, and from that finance they bought an aeroplane, and after that company has announced that how much return we will be providing you guys, it depends on the performance of underlying asset. It means there will be no fixed return. Those return, they will depend on the performance of XYZ aircraft which company has bought it. Plus, if someone is having 5% sukuk, so that person is technically, you can say, is the owner of that underlying asset, but how much? 5%. Okay, let's see. A bond in Islamic finance where the lender owns the underlying asset and shares risk and rewards of ownership. Like I have just explained, you will be getting a return, but that return will depend on the performance of underlying asset. You will not be getting any fixed return. Equity in Islamic finance where profits are shared according to the pre-agreed contract, dividends are not paid as such. So actually, if you recall, the equity in Islamic finance where profits are shared according to the pre-agreed contract, dividends are not paid as such. So the second one is actually mudarba. The second one is mudarba. It is actually representing a mudarba. Trade credit in Islamic finance where a pre-agreed markup is agreed in advance for the convenience of paying later, that is muraba. Then last one, a lease in Islamic finance where the lessor retains ownership and risk and rewards of the ownership of the underlying asset, that is ijara, Islamic financing. But our answer is the first one, okay? Now, sure, let's go ahead. Dividend policy. Which two of the following are assumptions for Modigliani and Miller dividend irrelevancy theory? Number one is imperfect capital market. That's false. According to actually, they have assumed that stock exchange is a perfect capital market. Here they have written imperfect. And perfect capital market means where BOD and shareholders are having the same information. Perfect capital market means where BOD and shareholders are having the same information. That is the meaning of perfect capital market. So they made the assumption for perfect capital market, not imperfect. No tax or tax preferences, that is true. According to dividend irrelevancy theory, either there is no tax or there is the same tax. Now there's a question. So no tax, okay, that makes sense. What do you mean by same tax? Wait. Actually, according to dividend irrelevancy theory, either there is no tax or there's a same tax. Same tax means actually either the shareholder is getting dividend or capital gain. In both the ways, he will be paying the same tax rate. Normally, we know that tax rates are different, but not in everywhere. There are a number of countries where the tax rates are same for the dividend and the capital gain. They assume either there's no tax or if there's a tax, it is same for the dividend and capital gain. Why? Because if the tax rates are different, like in UK, someone is I would say an additional rate taxpayer will be paying a really high tax rate on their dividend income as compared to capital gain. So that changes the preference. If I'll end up by paying more tax on dividends, so I'll be more interested towards capital gain rather than the dividend. So that is why said either there is no tax or there are no tax preference, means shareholders either getting dividend or capital gain will be paying the same tax. Another assumption is no transaction cost. That is, according to there's no transaction cost when you are buying or selling shares. Of course, it is incorrect. Practically, we do bear the transaction cost, though it is nominal, but you have to bear it. No inflation, there's no such thing said by So logically, these two. Okay. Now let's go ahead. In which of the following situations is a residual dividend most likely to be appropriate? Basically, when residual dividend policy is appropriate. Residual dividend policy means whatever company has earned, let's say in the current year, from that earnings, we will first take out all the money for the next year capital expenditure. Then we will also take out the money for the next year working capital requirement. So it means whatever you have earned, you have taken out the money for the next year capital expenditure, for the next year working capital requirement. After that, if anything is left, that will be actually paid in the form of dividend. That is residual theory. And logically, let me tell you, majority of the shareholders will not appreciate the residual theory. Why? Because it will actually create an erratic pattern. Erratic means uncertain pattern. Sometimes they will be getting a very high dividend, sometimes they won't be getting a good dividend, or sometimes they might not be even get a dividend at all. But let's see what they are saying. In which of the following situation is a residual dividend most likely to be appropriate? A large publicly listed company, no, it will not be appropriate because shareholders will not appreciate such a policy at all. A family-owned private company where the majority of the shareholders use dividend income to pay their livings, not appropriate at all. Try to understand what is written. A small family-owned private company where the majority of the shareholders use dividend income to pay their living costs. As I just this as I just said, that residual theory actually creates an erratic pattern, uncertain pattern. So will you be able to depend on the income stream which is uncertain? So how can you depend on an income stream which is uncertain to pay for your living cost? That is where the second one is incorrect. A small listed company owned by investors seeking maximum capital growth on their investment, that makes sense. Because residual dividend policy will give you the maximum dividend which you can get against your investment. Because residual means whatever is left, that will be distributed. In a tax regime where individuals pay less tax on dividend income, then nothing to do with the residual theory. In Modigliani and Miller dividend irrelevancy theory, the process of manufacturing dividends refer to which of the following? Actually, the way back when they gave this theory of dividend irrelevancy, they said dividend decision is irrelevant. Either you are paying, companies paying the dividend or not, shareholders will be indifferent. So obviously there were criticism, and someone asked a very simple question from them that, sir, what about those people that are living on dividends? Because they are saying dividend decision is irrelevant, dividend policy is irrelevant. So what about those individuals that are living on dividends? So they gave a very good reply to that. Then said for them, they can provide the dividend to themselves. The name is dividend manufacturing. The question is, how can I provide dividend to myself? It's very simple, according to Assuming Mr. Y has invested $100,000 in a company, and this gentleman is actually interested in dividend. Okay. But remember, he has invested $1 lakh in XYZ company. And according to dividend policy is irrelevant. Either you are paying the dividend or not will make no difference. According to what company should do? Number one, said, do one thing. There's no need to pay the dividend. Retain that cash and reinvest that cash to the project with positive NPV. And assume that stock exchange is a perfect capital market. Stock exchange is a strongly efficient market. And according to the moment you will be investing in a positive NPV project, this information will automatically go to the stock exchange and share price will increase. And those shareholders, they really want to get the dividend. They can provide the dividend to themselves. The name is dividend manufacturing. How? MM said you have invested the money, number one, in a positive NPV project. Second, stocks in a perfect capital market. This information will be reflected to your share price. Share price will increase. And those they really want the dividend, they can sell the increase in the investment, assuming where Mr. Y has invested, company did not pay the dividend, but the value of his investment has become 1,20,000. Now I'm just assuming that Mr. Y wants a dividend of $20,000, but company is not paying any dividend. So Mr. Y, according to MM, what he can do, he can sell the increase in investment. So Mr. Y can sell the increase in investment. What happens if he sells the investment, increase in investment? So Mr. Y will have $20,000 in the form of cash, let's say. Remaining investment market value will be 1 lakh. Obviously, number of shares will reduce. Obviously, there will be a capital gain on which he is going to pay tax. But the important thing is, dividend manufacturing means you just sell the increase in your investment. That is dividend manufacturing. Let's come. Dividend from a manufacturing, oh, come on. Investors selling some shares to realize what? Capital gain. Creative accounting to allow irrelevant. Investing plans designed to create regular, come on. Which of the following statement is correct? A bonus issue can be used to raise a new equity finance. False. Can I say bonus issue, they are in free? Bonus issue, by issuing bonus, you cannot raise any finance. A share repurchase scheme can increase both EPS and gearing. A share repurchase scheme. Now look at this. How do we calculate EPS? Obviously, we are not using, there's no need to go for IAS 33 EPS, which even though I love. In FM as well as in AFM, calculation of EPS is very simple. Just take profit after tax divided by total ordinary shares. Profit after tax divided by total ordinary shares. Okay. Now, I'm just assuming, okay. Assuming the profit is $20,000 and you have number of shares 1 lakh. Obviously, your EPS will be 0.2. Now, if company is going to buy back the shares, due to buyback of shares, number of shares will reduce. So the denominator will reduce. Assuming company has bought the 10,000 shares. Profit is same, everything is same, but number of shares will be now 90,000 rather than 1 lakh. Now, if I divide 20 by 90, I'm getting EPS $0.222. So it can be seen that when company is going to buy back, repurchase the shares, EPS will increase. Now they have said one more thing. Gearing will also increase. Gearing means here we are talking about financial gearing. Financial gearing, which shows the proportion of debt and equity in your business. You can use the formula debt upon debt plus equity or debt upon equity. Now, very important point. When company is going to buy back the equity, due to buyback of equity, your equity will reduce. Now try to understand. Assuming the debt is $50,000, I'm just assuming, okay? 50. Equity is assuming $1 lakh. So make it, I'm again just assuming, let's say the equity is $2 lakh. So let's see what is the percentage of debt. 50 divided by 250, I'm getting 20%. Now what company has done, company has bought back the shares. If you are going to buy back the shares, then your equity will reduce. 50,000, the debt is same, and let's say from 2 lakh, we have come down to, let's say 150 because we bought back 50,000. We bought back the shares, and due to that buyback of shares, equity is reduced by assuming 50,000. Now let's see, 50 divided by 200. Now the gearing is 25%. So basically, when you are going to repurchase your shares, so it can be seen that your EPS will increase definitely, and your financial gearing will also increase. So let's see. argued that financing decision is more, no. According to investment decision is more important than financing. Investment. Shareholder usually have the power to increase dividend. Come on, students. I wish shareholder had that power, but I'm sorry. Shareholders do not have such power at all. At all means at all. False. False. Okay. Let me just give you the idea about the dividend policy. Students, there are different number of dividend policies are possible, which companies they might follow, any one of them. One is, you can say, constant payout ratio. How do we calculate payout ratio? Simply, I will take the dividend divided by PAT. That will give me the payout ratio, or D naught upon EPS. That will also give me the payout ratio. Because how do we calculate EPS in FM? Simply we calculate EPS, profit after tax divided by total ordinary shares. So some of the organizations, they might follow constant payout ratio. But let me tell you, shareholders, they will not be happy if a company follows constant payout ratio. The question is why they will not be happy. Because your payout ratio is constant. Normally, organizations' earnings are not constant. Let's say company pays 40% of their earnings as dividend. So 40% is constant. Can I say 40% of 100 million is different? 40% of 80 million is different, and 40% of 200 million is different. Since the earnings are not constant, so even constant payout ratio will create an erratic pattern, and shareholders, they do not appreciate erratic pattern of the dividend. On the other end, for example, if a company is, I would say, distributing a really large amount of their earnings in the form of payout, then there's a possibility it might attract the shareholders. For example, if a company is paying around 60 to 65% of their earnings in the form of dividend, then I would say it might attract number of shareholders. Because of course, any company which is distributing around 60 to 65% of their earnings, then you can say they are actually distributing a very significant amount of their earnings that might attract the shareholders. But otherwise, normally constant payout ratio is not going to attract the shareholders because of erratic pattern. Residual dividend policy, as we have already discussed, residual dividend policy again will create an erratic pattern. There's a possibility sometimes shareholder they will be getting a very high dividend, sometimes very low dividend. Sometimes there's a possibility they might not be getting any dividend. Obviously, shareholder will not appreciate residual dividend policy. There is one more possibility, that is constant annual dividend growth rate. Okay. Now, if your company follows constant annual dividend growth rate, then you need to make sure the growth rate in the dividend should be real. Now, listen carefully. Here, the real means higher than inflation. This real is not the real which you people we discuss in investment appraisal. Here, it is different. When we say growth rate, then it should be real, means higher than inflation. Then it should be realistic. Because if you are saying that we will be following a 40% annual dividend growth rate, does not looks realistic. Then repeatable. What do you mean by repeatable? Basically, it should not be one-off growth. Then you should be able to repeat it again and again. And the growth rate which is repeatable, that is also realistic. If you cannot repeat it, then it's not realistic. Assuming the way back, if someone has taken around, let's say, 99 marks in their FIA stages. So obviously, after getting 99 marks or maybe 100 marks in any of the FIA papers, it does not mean now that child is going to get always 100 marks in every paper. It's not repeatable, it's not realistic. Now, students, come here. I hope you people can see the data. We have got sun company, moon company, and night company. And I want every one of you to try to evaluate their dividend policy. For that, I'm giving you around 5 minutes. So please attempt it. Then we are going to. Okay, now so let's try together. Look at this. Sun company dividend from 100, it becomes 110, then 121. If I multiply this 100 with 1.1, I'll get 110. If I multiply this with 1.1, I'll get 121. So I can see a constant growth. Payout is not constant. 100 divided by 200 will give you 50%, but 110 divided by 110 divided by 200 will not give you 50%. So in Sun company, constant growth. Now Moon company, 50 upon 100 gives us 50%. 150 upon this 50%, and this is also 50%. So can I say constant payout ratio? Constant payout ratio. Then night company, they did not pay the dividend, then a really big amount of dividends. Can I say residual policy? Let's check. Can I say A is the answer? Constant growth, constant payout ratio, and residual. Now let's try this. Operational gearing. Operational gearing, how do we calculate? Very simple. Actually, operational gearing gives you the information of fixed cost of running the business. Operational gearing is also a measure of business risk. Contribution. Of course, how do we calculate contribution? Sales minus variable cost. So of course, while reaching the contribution, you have deducted all the variable cost divided by PBIT. The higher is the gap between contribution and PBIT, it means higher is the fixed cost of running the business. The lower is the gap between contribution and PBIT, it means lower is the portion of fixed cost in the business. How do we calculate contribution? Simply sales minus variable cost. Sale is 10,000, 123 minus 70% of cost of sale, 10% of expenses are variable. Cost of sale is 7,222. Take 70% of this minus 10% of these expenses. PBIT they have given us. Profit before interest and tax 1902. Let's see. 1010. Please, I want you guys also use the calculator. Students, I'm getting 2.61111861 times. Let's see. So 2.61. Okay, what is the ELW financial gearing ratio? They're giving you the formula. Debt upon debt plus equity. Debt upon debt plus equity. Using what? Market values. So you'll be using market value equity, market value debt to calculate financial gearing to the nearest percentage. Okay. Market value of equity. We'll take ordinary share capital divided by par value. Ordinary share capital divided by par value into P naught, current share price. Ordinary share capital, we have got 100 million. Par value, we have $1, so it will remain 100. Into current share price, which is X dividend. Nothing is mentioned in the price. We always assume is X dividend. The ordinary shares are currently quoted at 5.5. So simply, it becomes 550 if I'm not wrong. So the market value equity is 550. Loan notes are trading at 125 per 100. Loan note 500 multiply by 125 divided by 100. So 500 into 125 divided by 100. 625 market value of debt. And the formula is debt upon debt plus equity. And student, let me tell you one thing. Some of the students, they make one more mistake. Don't do that. When you are calculating financial gearing on the basis of market values, then after calculating market value equity, we never add any reserve to that. Never. When we calculate financial gearing by using book values, then we take the total of equity. Total equity means I will take share capital, premium, even revaluation reserve and reserves as well. So when we are calculating financial gearing by using market values, so after calculating market value equity, you are not supposed to add any reserves. But when you are calculating financial gearing on the basis of book values, then we do take reserves as well. Right now it's market value, so 625 plus 550. So 625 divided by 1175. Students, I'm getting 53.19 something, so take it 53%. Okay. Students, if your examiner gives you the preference shares, they are also a part of your debt in case of calculating financial gearing. What is the market value base gearing of the company defined as a prior charge capital divided by equity? Simply total debt, including preference shares, divided by equity. By using what? Market values. Let's first calculate market value equity. Ordinary share capital divided by par value. Par value is 50 cents, means $0.05. That will give us issued shares into current share price, $5. So 8,000 divided by 0.5 into 5. I'm getting market value equity 80,000. I'm getting market value equity 80,000. Okay. Market value bonds. Market value of bonds is equal to, I'll take 4,000. Right now, bond is having a market value 105. per 100. So 4,000 into 105 per 100. Market value bond is 4,200. Bank loan students. How do we calculate bank loan market value? Can I say bank loans book value is market value? Because bank loan is a financial instrument which is not traded at a stock exchange. So the instrument which is not traded at a stock exchange, we assume book value as market value. Market value of bank loan is the book value. Preference shares, market value of preference shares. We'll take first preference share capital, which is 2,000 divided by par value. The preference shares have a nominal value $1. So par value is 1 into P naught, current preference share price, trading at 80 cents means $0.8. So we'll get 1,600. And how to calculate financial gearing? They've given us a formula: debt divided by equity. Market value equity, we have calculated 80,000. Bond 4,200. Bank loan book value is market value. Preference share is 1,600. So 4,200 plus 6,200 plus 1,600 divided by 80,000. I'm getting 15% students. Financial gearing, I'm getting 15%. Let's see. Okay, now. If the equity issue goes ahead and the bank loan is redeemed, what will be the new EPS figure? Okay, now, students, you need to know one thing. If you're going to issue the shares, obviously your number of shares will increase. But whatever the cash comes, if you utilize that cash to buy back to pay off your loan simply, in that case, you are going to save interest. When you will be saving interest, then your earnings will increase. And obviously, when earnings will increase, then your profit will also increase. So whenever there's a scenario that we are issuing shares to pay loan, then you just need to do a very simple calculation, and that calculation is, first of all, take existing PAT, take existing profit after tax, then simply add interest saving after tax. You will get revised earnings. So revised earning divided by total of ordinary shares, including obviously new shares also. Now let's come here. Okay, Beer World Company has 100 million equity shares. They are already 100 million issue, and just reported profit after tax 55 million. Fine. A new issue of 50 million equity shares at an issue price of 1.5 is being considered. Now listen. You are already having 100 million shares. If you will issue 50, so your new number, total number of shares will be 150. That is existing 100 plus the new 50 becomes 150. And how much finance will you raise? 50 multiplied by 1.5. Calculate. 50 multiplied by 1.5, you will be raising 75 million. Okay. Then all proceeds would be used to redeem a bank loan with an annual rate 8%. Beaver pays corporation tax how much? 20%. And it says assume that operating profit before interest and tax remains constant. So very easily we'll take existing PAT, which is 55 million. Add interest saving after tax. 75 million into 8%. Tax rate is 20, so 1 minus tax rate. Because you will be paying the bank loan, you will be using the entire proceed to pay the bank loan. So on entire 75 million, you will be saving 8%. So actually there's an interest saving after tax is 4.8. Your revised earnings will be 59.8. Here comes the EPS, 59.8. Now your number of shares will be 150. Students, I'm getting $0.39866 and so on. If you don't get the exact answer, then obviously you will always choose the closest option. Let's go. Can I say first one is the closest, not the last one? Let's check. It is 3, 9, then 8, then 6. This is more close. It's almost the A, not the D one. I hope it is clear to everyone. Yes or no? Okay. Before discussing this, just a minute. Let me share one page with you. Okay, students. Obviously, now there are different and the new types of sources of finance are available due to fintech companies. Because the way traditionally we were doing the business, now we are doing the business, it's not the same. It has been changed. And there's a really big change. So one way of raising the finance is crowdfunding. The use of crowdfunding by companies is looking to raise what? Equity finance. Now stop. Equity finance. If you come across a multiple choice question where your examiner says crowdfunding is for debt, obviously incorrect. Crowdfunding is equity finance. It's becoming increasingly common and is closely tied to growth of internet technology, which enables millions of potential investors to be accessed. Crowdfunding allows a company to access a finance by using what? Online crowdfunding platform to pitch for the finance from a large number of investors. I think you people definitely have seen Shark Tank of different countries available. Can I say when individual they go for a Shark Tank, they don't go actually for debt, they go for actually equity. Crowdfunding allows a company to access finance by using an online crowdfunding platform to pitch for the finance from a large number of investors who choose whether or not to invest based on the quality of the proposed business plan and quality of the management team, their skills and experience. So basically, crowdfunding is for equity financing. There are different platforms available where you go and just share your business ideas. You will get number of investors. Of course, those they will be interested, they will automatically going to contact you. They will give you the equity finance. But main concept is crowdfunding, equity finance, peer-to-peer lending. Now it is not necessary always to go to the bank and get the loan. Now peer-to-peer lending is available. Peer-to-peer lending connects established business looking to borrow with investor who want to lend via online platform. Very important. Peer-to-peer lending, that is when you are after getting a loan, not equity financing. Platform usually requires borrower to have a track record. It means if your business is new, your business is just a startup, you will not be able to get peer-to-peer lending. Platforms usually require borrowers to have a trading track record, to submit financial accounts, and will perform credit checks as part of credit assessment. Platform offers either a fixed rate or in some cases, lenders bid for the loan by offering an interest rate. So simply peer-to-peer lending, again, there are online platforms where peer-to-peer lending is possible. The main concept is that is for loan, not for equity. Another concept is it's not available for every business to every business. If your business is just new, your business is just a startup, you will not be able to get peer-to-peer lending, because for peer-to-peer lending we need a proper track record. Now let's go back to the question which we were doing, and we have to redo because student, look at question 180 once again. Actually, we are raising $75 million. Entire $75 million will be used to pay the bank loan. Obviously, when I'm going to pay the bank loan, after the payment of bank loan, we will save the interest. If there will be interest saving, then your earnings will increase. Obviously, just your earnings will not increase, your tax will also be increased. So how will you calculate the revised PAT? Existing profit after tax, add interest saving after tax. 75 million is the amount of the loan which you are going to repay. On that 75 million, you will be saving 8% interest. That will actually increase your earnings. Then on that increased earnings, you have to pay tax. That is why what are we doing? We are adding interest saving after tax. 1 minus tax rate. Tax rate is 20%. So your earnings actually after tax will increase by 4.8. Why we need increase in earnings after tax? Because we are required to calculate EPS. And in EPS, we use profit after tax, not before tax. So these are your revised earnings. Existing number of shares, they are 100 million. And new number of shares company will issue 50 million. So altogether, there will be 150 million shares. That will give you the EPS of 0.39866, which is actually equal to 0.399. I hope it is clear now. Please, student, reply. Is this clear, student? Please reply. Just waiting. Okay, great. Now let's come here. 181. Which of the following statement is true? Correct. Fintech has created a large market for private individual to trade small amounts of currency on the currency future contract. And it's absolutely false. Currency future contracts, future markets, they are standardized markets. How can you do all this? Okay, now companies are increasingly looking to raise equity finance by using what? Students, peer-to-peer lending is for equity or debt? Peer-to-peer lending, is it for equity or debt? Can I say for equity financing? We have crowdfundings, not peer-to-peer lending. Crowdfunding is for equity finance. Peer-to-peer lending is for borrowing. We're talking about loan. So can I say both the statements are false? Is that clear, student? Please reply. Both statements are false. Neither one, no two. I hope it is clear, because before discussion of this question 181, we have discussed the crowdfunding and peer-to-peer lending. So actually crowdfunding is a quick way of raising equity. Peer-to-peer is for lending. Now let's see. 182. Which of the following statement is correct? A drawback of crowdfunding as a means of raising equity finance is that it takes a long. False. It does not take long time. Just an example, if someone goes to the Shark Tank and let's say they accept your idea, they like your idea, you will get the financing immediately. Even on those platforms where you are going to pitch your business idea, Obviously, when any investor is going to accept that idea, you will immediately you quickly get the equity. It's not a delay arrangement. Okay, then peer-to-peer lending has developed to allow the students. Can I say false? We have just discussed. In case of peer-to-peer lending, can I say you have to have a proper track record? If the proper track record of a business is not available, you will not be getting peer-to-peer lending. So peer-to-peer lending is not available to startups. Is that clear? Peer-to-peer lending is not available to startups. It is available to the established businesses. So neither one nor two. Okay. Small and medium-sized enterprise entities often face a funding gap problem. Are the following statement about SMEs true or false? SMEs will often experience a funding gap. Obviously, SMEs, they won't be able to raise the finance so easily due to them being seen as a obviously higher risk investment. Can I say true? Assuming if you have the option to buy a bond of a SME and a bond of a listed company, obviously a larger company, I'll go for a listed larger company. I will not go for SMEs. First, I will not go for the debentures because it's not acceptable in Islam, but I'm just giving the idea. You have the option, buy the bond, assuming in SMEs and other, obviously you will go on the other side. Founding shareholder of an SMEs will often have to sacrifice limited liability in order to obtain. That's true. You are running a small and medium-sized enterprise. Your liability normally will not be limited. It will be unlimited. If you're taking a bank loan, if something goes wrong, you have to pay even from your personal belongings. A lack of suitable, sufficient non-current asset increases the funding gap. Normally, you will be able to get a loan for a long-term basis if you have got valuable non-current assets. But here, a lack of suitable, sufficient non-current asset increases the funding gap. So all are true. All are true. Okay, students, let's resume the class. Next question. Indicate whether the following statement relating to small and medium-sized enterprises are true or false. Medium-term loans are harder to obtain than the longer-term loans for SMEs. That's true. Because for long-term, there's a possibility if you have got high-value tangible assets, you will be able to get the loan. But for a shorter term, you need to have a really good cash generation ability, which is difficult to prove. So medium-term loans are harder to obtain as compared to long-term for the SMEs. SMEs are always, obviously, they are prone to funding gaps. Private individuals or groups of individuals can invest directly into a small business. What is this known? Reverse factoring, no. Reverse factoring and supply chain finance is the same thing. Venture capital is no. Venture capital is basically they're a wealthy group of companies and they will be investing in those businesses where there's a well track record and everything. So last one, business angel finance. These are the individuals, they will be investing in small businesses where they don't have a well track record. Okay. Reverse factoring. Another name for the reverse factoring, you can say invoice discounting as well. In invoice discounting, actually what happens? We sell our debtors, obviously, to a bank, assuming, just an example, okay, that you have got debtors of $1 lakh. You will be getting this amount after 2 months. There's an export. I'll be getting this $1 lakh, but I'm not going to get today. I'll be getting after 2 months. Now, I really want this amount today. I want my credit sale technically to become a cash sale. I want my debtors to pay me as soon as possible. But I know that the arrangement is they will be paying me after 2 months. Okay, my company contacts XYZ Bank or any other institutions. for invoice discounting. Now, how this invoice discounting works, my company informs the bank that we have got debtors of $1 lakh. We will be getting this amount in 2 months' time. What bank does, assuming bank gives you $90,000 immediately. Obviously, on this $90,000, bank will charge you the interest. Number one. Number two, after 2 months, when you will be getting the entire 1 lakh amount, what bank is going to do? Bank will take the $90,000 plus the interest plus a fee. The remaining amount bank will pay you. That is invoice discounting. So in invoice discounting, actually what is happening, I'm just technically taking a loan on my invoices. Now, what is the benefit of this invoice discounting, reverse factoring? The benefit is immediately I'll be having a cash with me. My working capital problem will be over. So my cash problem will be over. That is invoice discounting. You can say that as your reverse factoring. Okay. Indicate whether the following statement relating to supply chain are true or false. As I mentioned, the supply chain is just another name for the reverse factoring. Just a minute. Okay. SCF is considered to be a financial debt. Actually, it's not a debt. Technically, it's not a debt. It's not financial debt. Indicate whether the following statement relating to supply chain are true or false. SFE is considered to be a financial debt. We said that's not true. SCF allows on a SMEs to raise finance at a lower interest rate than would be normally be available to it. So that is true. Because whoever gives you a supply chain services, it is not necessary it has to be a bank. For example, there's XYZ organization, assuming Y Limited. They are providing you supply chain facility. Now try to understand how this supply chain facility will work. Assuming my company is A Limited, I have bought goods on credit. I'll be making the payment after 3 months. Now, supply chain facility can also work like this. Assuming I have contacted Y Limited, I said, see, I'll be making a payment this time. I'll be making $1 lakh. I'll be making $1 lakh to the supplier, not today, after 3 months. After 3 months. But A Limited wants this Y Limited to pay my supplier right now. The question is why Y Limited will pay the right now, I'll tell you. The benefit would be there's a possibility of getting early settlement discount. Of course, A Limited will not be getting that early, will not be able to get the benefit from this. SFE supply chain, they are paying, assuming $97,000 to the supplier. And let's say supplier is giving early settlement discount. So supplier is paid immediately. Now the question is, technically, Y Limited is paying to the supplier on the behalf of A Limited. So what is the benefit? Obviously, A Limited and supplier relationship will improve. Now, instead of making a payment of $1 lakh, everything is settled in $97,000. But now after 3 months, and there is a now possibility, maybe little longer than this, A Limited will pay to Y Limited the agreed amount. Of course, it will be 97,000 plus whatever XYZ interest is there. Maybe 98,000 plus whatever is the interest. What is the benefit to A Limited? Number one, there was a possibility that A Limited might not be able to pay after 3 months. Now there's a possibility that A Limited and Y Limited, they had an arrangement where A Limited will make payment to Y Limited, but after 4 months rather than after 3 months. This is a supply chain finance, but this time by using this supply chain finance, you have made payment to the creditor, to the supplier. Now, due to this supply chain finance, you can do another thing also, like we have already discussed, debtors. Your debtors will pay you after 3 months. So through invoice discounting, you can technically, through invoice discounting, you are technically converting your credit sale to the cash sale. So this supply chain finance could be for the suppliers to make the payment early, and this can be for our own credit sale technically to convert that into cash sale and get the amount immediately. The benefit is, if for example, if this is happening, so I'm not taking a loan from a bank, I will not be paying a high interest rate. Interest rate will be lower. Okay. Students, the next topic is cost of capital. 187, what are they asking? Dividends are expected to continue to grow at the same average rate into the future. According to the dividend valuation model, what should be the share price, P naught? Start of by 4 to the 2 decimal places. So actually, we need to calculate P naught. P naught is equal to, can I say, D naught? 1 plus G KE minus G. Student, I want everyone to attempt this question. I'm giving you 3 minutes. You should be able to do that. Okay, students, can I say, first of all, we have to calculate annual growth rate. Last dividends which they have given us 423. The first is 220. How many years are there? 5. So power is going to be 1 upon 4 minus 1. 1 upon 4 means 0.25. Okay. So 423 divided by 220. The power is 0.25 minus 1 into 100. I'm getting technically 17.755, or make it 76%. Okay. Cost of equity, they've given us K 25%. How many shares are there? 4 million. 4 million shares means 423. We are ignoring 3 zeros. Divided by 4,000 will give me D naught. Dividend per share. Logically, dividend per share is $0.10575. So here comes the P naught is equal to D naught into 1.1776 divided by KE minus 0.1776. So P naught is equal to, let's see what comes in the denominator. I'm getting 0.1245 in the denominator, 0.25 minus 0.1776. Let's see, 0.1245 divided by 0.0724. Students, I'm getting 1.719 or 1.712. Let's see. I hope it is clear to everyone. We are getting 1.72. Okay, now IPA company is about to pay a 0.5 dividend. Whenever your examiner says we are about to pay the dividend, in that case, logically, your share price will become diff. Your share price will have the impact of upcoming dividend also. IPA company is about to pay a 0.50 dividend on each ordinary share. Its earning per share is 1.5. Net asset per share is $6. Current share price is 4.5. 4.5 minus this. X dividend is 4. What is the cost of equity? They are asking us to calculate K. Okay. Now come here. Students, there is one, I would say, model. The name is Gordon growth model. G is equal to B. RE. RE is actually return on equity. We take profit after tax. If we have preference shares, then we do deduct the preference dividend also. But normally we don't have. So simply PAT divided by total equity. Okay, into 100. Now keep watching. EPS is profit after tax divided by total ordinary shares. So I can say EPS, earning per share. I can say earning per share is simply a profit after tax per share. So if I replace profit after tax with EPS, okay, divide by total equity. Actually, your total equity is equal to net assets. So if earning per share means profit after tax per share, if I divide this with net assets per share into 100, this will also give me the return on equity. Earning per share divided by net asset per share will also give me return on equity. Okay. Now B is the retention ratio. For example, if my company is paying 40% dividend, it means they are retaining 60%. If my company is paying 50% dividend, it means they are retaining 50%. So how do we calculate the retention ratio? It's very simple. 1 minus payout ratio. How will you calculate payout ratio? Simply dividend per share upon earning per share will give you payout ratio. Now let's apply all this in this question. We have been given earning per share EPS 1.5 and net asset per share is 6. We can calculate return on equity. So let's see the percentage of, am I right? EPS is 1.5. Earning per share is 1.5. Net asset per share is 6. So students, I'm getting 25%. Now payout ratio. Dividend per share upon earning per share. 0.5 upon 1.5. Logically, payout ratio is this. We can calculate retention ratio. 1 minus 0.33. So the retention ratio is this. Now we can calculate the growth rate. (16.675%). Okay. We need KE. Dividend is 0.5 into 1.16675 divided by P naught, which is 4 into this. So 0.5 into 1.16675 divided by 4 plus 0.16675. Students, I'm getting 31.2 6%. Let's see. Nearest whole, then it is 31. 31%. Okay. Which of the following best describes systematic risk? Systematic risk is not a diversifiable risk. The chance that automatic process may fail, false. The risk associated with investing in equity. The diversifiable risk is not a diversifiable risk. The residual risk associated with the investment in a diversifiable portfolio. Basically, when you invest in a well-diversified portfolio of investment, then what happens? Your unsystematic risk becomes zero, but you will have to bear systematic risk. So the last one is true. Okay. A shares in MS company has an equity beta 1.3. MS debt beta is 0.1. Gearing ratio is 20%, means debt is 20, equity is 100. The market premium is 8%. Market premium is the difference between RM minus RF. Risk-free rate RF is 3%. MS pays 30% corporation tax. Oh, okay, just KE. KE is equal to RM minus RF equity beta. So students plus we got RF. So they have given us equity risk premium. RM minus RM is RM minus RF is what? Equity risk premium. So equity risk premium is 8 into 1.3 plus risk-free rate is how much? 3%. Students, we are getting 13.4%. We are getting 13.4%. Okay. Are the following statement true or false? An increase in the cost of equity leads to a fall in the share price. True. P naught is equal to D naught 1 plus G K E minus G. Assuming current dividend is $2, growth rate is 8%, K is 12%, and let's see what will be the P naught. 2 multiplied by 1.08, we will divide this with the 0.04 because in the denominator you will have 0.04. I'm getting 54. Now let's take everything same and assuming KE becomes 15%. Let's see what will be the share price. 2 multiplied by 1.08. In the numerator, we are having 2.16 divided by technically 0.07. Student, the share price is 30.86. You can see that when KE increases, why? Actually, KE works here as a discount rate. Obviously, when your discount rate will increase, then present value will reduce. Your present value will reduce. I hope it is clear to everyone. Please, student, reply. Waiting for the reply. Is that clear to everyone? Yes or no, please. Come here. Investor faced with increased risk. Okay, finally. Yes. Opposite relationship. K reduces, then P naught will increase. The relationship is inverse. Investor faced with increased risk. will expect increased return on compensation. That is logical. If I'm making a high risk investment, so I'll be expecting a higher return. The cost of debt is usually lower than the cost of preference shares. True. KD1 minus C basically will be lower than actually what? KP. This will be lower and KP will be higher. It is like this. KP will be higher than KD1 minus T. All true. In fact, your K will be more than WACC. Normally, WACC will be more than KP and KP will be more than KD1 minus T. That's a normal relationship. I hope it is clear to everyone. Students, you can answer. Now let's come here. Okay, now let's try this one. Using dividend growth model, what is the cost of equity, K, for the company to one decimal? Okay. The following information is available for a listed company. Dividend recently paid is 0.10 per share. Dividend cover is, okay, any question? Check. Please, WACC is, what was the question? Students, WACC cannot be higher than KE. Please, come on. WACC cannot be higher than KE. Not possible at all. You people have done so many questions. Because when we calculate weighted average cost of capital, KE could be equal to WACC, WACC could be equal to KE if the business is 100% equity finance. Only one possibility is there. If company is 100% equity finance, then but please KE less than WACC, not possible. There's only one possibility, which is KE is equal to WACC. But there's a condition. If company is 100% equity finance, only then. Okay, now come here. Examiner is asking us to calculate KE. The following information is available for a listed company. Dividend recently paid is 0.10 per share. Dividend cover is 4 times. Dividend cover. EPS upon D naught. That will give us dividend cover. Dividend cover actually shows how many times company can repeat the dividend payments. P ratio is 5 times. P naught upon EPS. Growth rate is 8%. Okay. Now, students, by using dividend cover, we can calculate EPS. Then by using EPS, we can calculate P naught. Dividend cover, they have given us 4 times. Dividend cover into D naught will give us EPS. I'm just calculating EPS. Dividend cover multiplied by D naught. Dividend cover is 4. D naught is 0.10. 0.1. So I'll get 0.4. Your EPS is 0.4. P ratio multiplied by EPS will give us P naught. P ratio multiplied by EPS will give us P naught. So P naught is $2. Now we can calculate K. K is equal to D naught, which is 0.2 0.10. Growth rate is 8%. Current share price is 2 plus the growth rate. So let's see. 0.10 into 1.08 divided by 2 plus 0.08. Students, I'm getting 13.4%. Okay. Now let's try this one. Again, they're asking cost of equity. Okay. A company has announced that it will pay an annual dividend equal to what? 55%. Can I say if you are paying dividend 55%, then your retention ratio is 45%? Or you can say 0.45. I hope it is clear. When company pays 55% dividend, it means company is retaining 45%. Earning per share is 0.80. It has 10 million shares in issue. The return on equity is 20%. So G is equal to BRE. B is 0.45. Return on equity, they have given me 20%. So here comes the growth rate 9%. Current cum diff price is 4.6. So from this 4.6, I'll deduct the dividend, and the dividend is 55% of EPS. 0.8, take 55% of this, that will give you the dividend. 55% of the earning is dividend, which is 0. So 4.6 minus 0.44, P naught is 4.16. So K is equal to dividend, which is 0.44, growth rate is 9%. It's 1.09 divided by 4.16 plus 0.09. 0.44 into 1.09 divided by 4.16 plus 0.09. Students, I'm getting 20.5%. Okay. Which of the following are assumed if company's current WACC is to be used? If you're using the current WACC, capital structure will remain unchanged for the duration of the project. True. The business risk of the project is same as the business operation. True. Business risk of the project is same as the current business operation. True. Means there is no change in the business risk. The project is relatively small in size. Then true. All true. Because if your business risk changes, then we'll be using a risk adjusted WACC. Now come here. What is after tax weighted average cost of capital of GFV company to 1 decimal? Market value, on market value basis, GF company is financed 70% by equity. Debt is 30. The company has after tax cost of debt after tax. Okay. KD1 minus C, they are giving us 6%. Equity beta is 1.2. Risk free rate is 4%. Equity risk premium is the difference between RM minus RF. So K is equal to risk free rate is 4%. Equity risk premium is 5 into 1.2. Students, K, I'm getting 10%. So here comes your WACC. K into equity plus KD into VD divided by 100. I'm getting 8.8%. Okay. What is the cost of capital for these preference shares? You just need to calculate KP. and 8% irredeemable 0. KPS D naught upon P naught. 8% irredeemable 0.5 preference shares is being traded at 0.3 cum diff currently. It has nothing to do with the tax rate, no issue at all. D naught, how will you calculate? 0.5 par value into 8%. Students, I'm getting D naught 0.04. From cum diff, you will deduct the dividend to get X diff price, which is 0.26. Students, I'm getting 15.38, one decimal, so make it 15.4. Let's recheck. Okay. Perfect, students. Now let's check this. Why do assumes increased gearing will reduce the weighted average cost of capital? Because interest payment are tax deductible. Debt is cheaper? No, this is not the reason. Interest payment are tax deductible. A reduced level of expensive equity. Let's see the next one. Are the following statement true or false? The asset beta reflects false. Can I say asset beta only reflects business risk? Only equity beta reflects both the risk. Total risk is the sum of systematic and, of course, total risk means both systematic and unsystematic. Assuming that beta of a debt is 0. Beta debt is 0 will understate financial risk when ungearing on equity beta. False. Please read it again. Assuming that debt or beta of a debt is 0 will understate what? Financial risk when ungearing an equity beta. Can I say when you are going to ungear the equity beta, you will get a beta asset, and beta asset only shows the risk of business. So basically, when we are assuming debt beta is 0, it does not mean that we are understating the financial risk. Actually, financial risk is measured through financial gearing, through the level of debt. When there is a debt in the business, you will have to face the financial risk. Okay. Using CAPM, what would be the suitable cost of equity for Shema, I believe, to use it in its appraisal in the farm machinery project to 1 decimal place using CAPM? Shema company is a company that manufactures ships, okay? It has an equity beta 1.6 and debt to equity ratio is 1:3, means debt is 1, equity is 3. It is considering a new project to manufacture farm vehicle. See, you are doing something different, diversification. In case of diversification, actually, we need to have a asset beta of the new industry. An asset beta of the new industry will be geared with your own gearing. Trent company is a manufacturing of farm vehicle and has an asset beta. Thank you very much. Examiner has already given you the beta asset of new industry. Tax rate is 40%. You have to gear up this asset beta with your own financial gearing to convert that asset beta into beta equity. And always remember one point. Beta equity is more than beta asset. Beta equity is a two risk beta. Beta asset is one risk beta. Beta equity has two risks. One is financial, another is business. Beta asset has only one risk, which is business risk. Now we need to calculate beta equity is equal to beta asset. And we know that beta equity has to be higher than beta asset. So we'll take market value equity plus market value debt 1 minus tax rate divided by market value equity. Another formula is, if I need beta asset, then we use this. Market value equity divided by market value equity plus market value debt 1 minus tax rate. So you should be very good when to use which formula. Right now we are converting beta asset into beta equity, so I'll be using the first one. 1.1 market value equity is 3. Debt is 1. Tax rate is 40%. If tax rate is 40%, then 1 minus t will give me 0.6. Students, I'm getting equity beta 1.32. So simply K is equal to RF plus RM minus RF. Let's see. Market risk premium is the difference between RM minus RF is 3%. Risk-free rate is 5. Students, K is equal to 8.96%. They are saying to 1 decimal, so take it 8.9%. I hope it is clear to everyone. Yes or no, please reply. Students, you can comment on that. I hope this entire calculation is clear to everyone. Yes or no? I'm waiting, students. Okay. With a rounding off, let's make it 9%, which makes more sense because it was 8.96. Okay, fine, 9%. So 8.96 with a little bit rounding off, make it 9 because 8.9 after that we have got 6. So it's better to write 9% rather than 8.9. Okay, students. Now, ignoring tax using the capital asset pricing model, calculate a suitable risk adjusted cost of capital for the new project. Liha company is an all equity finance company. Now listen, when companies 100% equity finance, then it is, you need to know one thing, then your beta asset technically is equal to beta equity. Because 100% equity finance company means you are not facing any financial risk. Then logically your beta asset is equal to beta equity. Then in CAPM, in capital asset pricing model, when this is the case, RF plus RM minus RF, you will be using beta asset. Obviously, normally we use equity beta, but when company is 100% equity finance, then in CAPM, for calculating K, instead of equity beta, you will be using beta asset. So this company is 100% equity finance. which wishes to appraise a project in a new area of activity. Existing equity beta is 1.2, not relevant. The industry average equity beta for the new business are 2. The industry average equity beta for the new industry area is 2. We need to have the asset beta, not the equity beta. With an average gearing, debt upon debt plus equity is 25%. Debt upon debt plus equity is 25 means your market value of debt is 25%, your market value of equity is 75%. And ignoring, they are saying ignore tax. Now listen carefully. It's a diversification scenario. In diversification scenario, actually, first we need the beta asset of a new industry. Whatever the beta asset comes, same beta asset as it is will be used in CAPM. Why? Because the company for which we are calculating K, it is an 100% equity finance company. When your company is 100% equity finance company, then technically your beta asset and equity both are the same. So let's first de-gear this beta equity to calculate beta asset. Okay. Right now we are converting equity beta to beta asset. So we are converting 2 risk beta to 1 risk beta. So obviously the answer should be less than 2. Market value equity is 75%, 75, market value of debt 25, and they're saying ignore tax. So, okay. Your beta asset is actually 1.5, and the same beta asset will be used in CAPM because company is 100% equity finance. So let's see. Market risk premium is the difference between RM minus RF, and risk-free rate is 5. Market risk premium is 4 into 1.5. Students, I'm getting 11%. Please check. I'm getting 11%. I hope it is clear to everyone. Are the following statement true or false? As explanation of why asset beta is generally lower than an equity beta. Okay, let's see. An equity beta also includes the element of financial risk. True. Because beta equity has 2 risks, business and financial. Asset beta contains less business risk. Asset beta is a measure of business risk, not less. This is the only due to tax relief on debt finance. Come on. It's true, false, false. Okay, students, now let me explain the agenda for the coming class. Actually, there was a plan to discuss 2 more questions, the long question from working capital management, which intentionally I'm not discussing. But in the coming class, let me just tell you the topics so that number 1, working capital management. There are 2 questions which I've already shared in the group. Second, we'll be discussing question on business valuation. Third, we will also be discussing question on risk management, Forex. So the coming live revision class, the focus will be on working capital management, business valuation, and Forex. Then after the next class, we will decide the agenda for the another class. And coming Monday, again, the timing is going to be same, 3 p.m. Pakistan time. And there's a possibility that duration of the class might be a little bit longer than this. And recording of first class, as today's class, will be available on the YouTube channel of Abid School. But upcoming classes recording will not be available. Upcoming live revision classes recording will only be available to our enrolled students. So students, thank you very much for watching this lecture. Hope to see you all in the next class as well. And I strongly believe that this class should have helped you, seriously. So last minute of the class, student, is there anything you want to say before I end the class? And one more thing, students, we are conducting these live revision classes for FR, PM, tax as well. and for ATX, AFM, SBR as well. For ATX, SBR, AFM classes, they have already started. So, okay, students, thank you very much.